3%, do we care? Is it psychological, or actually do you see a little bit of investor anxiousness?
Not much anxiety. Certainly it is an important number. It certainly is a psychologically important number as well. It's been 2014 since we've seen that number. Although many market commentators have called for that kind of 285 to 310 range for some time now. So I don't think the actual investors that we talk to every day are really shocked or surprised by this. I think it shows continued confidence in the global sort of, and particularly the U.S. growth momentum story. And I think for rates investors in particular, what's good about that or positive about that is it continues to give the Fed room to return to a normal sort of rate environment, and it continues to foster expectation that we'll see the planned hikes that are currently expected.
I mean, are you going to see fault lines? Does the market, I guess, needs to get used to trading back into, a market that is not supported by low rates or slightly marginal higher rates? What does it mean for how you view things?
Well, we've seen that since the start of the year. So I think we had that kind of stronger than expected inflation number in January. That really triggered what I think many people have called a kind of return to volatility in the markets. And that momentum around that volatility continued with the tariffs discussion, with the fiscal stimulus discussion. So I think we've now got several months of recalibrating our trading capabilities, and I think clients are ready. We certainly see people taking advantage of the trading opportunities this volatility presents. So I think one of the key positives in all this, in good volatility, if you like, is that there's two-sided views again, and there's less certainty and predictability around what's going to be happening over the course of the year. And of course, that leads to trading opportunities. As long as those opportunities are underpinned by strong liquidity and customers can get in and out of those positions, which of course is where we play a major role as a leading market maker, then I think is a very strong story.
So, Paul, let me bring you over to my chart. It's a very simple chart. It's basically, we entitled it, rightly so, Bond Traders Refocus on 3% U.S. Yield. Do you have a view on what happens after it touches 3%, or do we not really care?
Well, we care because I think the velocity with which the yield continues to rise, if it does, may indicate higher than expected inflation expectations. And of course, right now, we said the Fed expect core PCE at 2% at the end of the year. Right now, the majority of market participants expect 3 hikes in 2018. So we surely care because if the story changes for better or for worse, then that will drive more trading activity and there'll be a change in the market environment.